Welcome to the Do You Ever Wonder podcast. Ever find yourself wondering about the world's biggest topics? Join your host, Mike Haltman, CEO, board chair, and all-around deep thinker, as he dives into real estate, investing, national security, self-improvement, dating, networking, finance, and so much more. Expert guests, real conversations, no limits. Hit subscribe and get ready for insights, surprises, and conversations that will make you think. The Do You Ever Wonder podcast starts now.
Wow, that was quite the intro, and apparently I do cover quite a bit of territory on this podcast. But today we have a very important topic. I think we have a very important guest. As we all know, we have attacked Iran. And if anyone watches the bond market on Friday, we had a very hot producer price index number. And if you were watching the 10-year bond, it fell quite hard, quite a bit. Over the weekend, we attacked Iran, and crude oil was up quite a bit. And today, the 10-year bond is up 9 or 10 basis points. So there's a lot of volatility out there. I think that for this specific topic, which is going to be, we have one of the kings of the commercial real estate brokerage business. And, there's a lot of things that I'd like to know about. And, the maturity wall is certainly one of them. The fact that lenders are probably a little bit hesitant these days, that underwriting is a little bit stricter. Recently, I wrote an article, should you choose a banker or a broker? And I think that's an important point, and a lot of it depends on who you are as a borrower and who you are with what your deal looks like. So without any further ado, I would like to welcome Stuart Gelb, CEO and President of the Liquidity Source. Welcome, Stuart.
Thank you, Michael. Great to be here, and thank you for inviting me.
Absolutely. So, I think first, let me get your impression, geopolitics. We have inflation here. We now have a lot of turmoil on the global stage. Do you think those factors are going to impact, and if so, how hard, the commercial mortgage lending business?
I think it does, but I think long term, like everything else, like the markets today are pretty volatile in general because of everything that's going on. But at some point, it smooths out and things get better. I'm really pro business and pro the market. And I think, AI, and there's a lot of great stuff that we're seeing, but, these things interrupt and people get, scared and volatile. The algorithms on the market, you don't get a sense of stability. But, it wasn't, 20 years ago when markets were like, when NASDAQ was like 3 or 4,000, and today it's 23 or 24,000. And I'll never forget, actually, in the late 80s when I was in business, I think when the market crashed, I think the Dow was 900 or something like that, right? Or like
You think even less?
1987.
I think less than that.
Yeah, and today it's, almost 50,000. So, life goes on. We get through
Well,
these things. So,
to bring it to a little closer point in time, I owned a commercial mortgage business back in 2008. And, the world was certainly burning at that time. Things couldn't have
yeah,
been more calamitous if they tried. And yet things bounce back.
absolutely.
The markets are very fluid, very strong, and you need to have a little bit of a strong stomach. But yeah, I know you do. So from my experience, explain to me. So I did write a little while ago about should you choose a bank or a broker, and I talk about plain vanilla deals versus deals with a little bit of hair on them. And can you describe what you would consider to be a plain vanilla deal, in terms of, the quality of the project, the cash flow?
Sure. And even with that, I'll explain, what the changes that have taken place in the last couple of years and how we even got to this point. But yes, a plain vanilla deal, at least to somebody says, I have a multifamily, maybe 5 or 10 units, and there's no vacancies, or I won't have any vacancies for a year or two. And the location's great. The income's good. and I'm getting ready to refinance. And should I go to the same bank that I've been going to for the last 10 years? Because Joe's a great guy and he never steered me wrong. And what am I going to save going to somebody else? Maybe not. And who am I going to trust? Because, it's always about the trust factor, right?
100%.
So that's what I would call a clean, deal in right down the middle as far as the golf goes, that kind of thing.
So
So
multifamily, I mean, I know with different lenders, different properties are in vogue. Multifamily may be popular for one lender, maybe not for another. Owner occupied for one, maybe not for another. So every deal, so in those cases, if it's not a deal that the specific bank is is thrilled about in terms of sector, can that still be plain vanilla?
it can be plain vanilla. First of all, I would say if you said owner occupied, that's probably the most vanilla of all banks because they think that's great. Multifamily is probably one of the leading things because if you had a 40 unit building and a couple people leave and a couple people come back, it's still safe. As property types change, you get into things like office, which office has been very difficult. Most banks won't touch it, or if they do, they have uh, not the best pieces of how to get this done, and the debt service coverage changes, and the vacancies change, and the loans change. So it's very rough. So you want to go to the right bank, if at all. So you have to know where to go.
Well, let me ask you this. You mentioned multifamily and how for a lot of banks it's in their sweet spot. Not to be political about it, but what about multifamily, rent stabilized multifamily in New York City?
That's like another that's
Right,
completely another story,
right.
especially to stabilize because what's happened, I mean, even back in 2018 and 2019, people used to buy properties and it would be partly stabilized and partly free market. And it was a great deal and they overpaid, but then they hired their attorneys to get rid of the people that were there illegally. And then they went to people that were there for 10 or 20 years and offered them money to make it free market. And they made a lot of money. And then when the net operating income went up, they'd go back to refinance. It was a wonderful thing. And then in 2018 and 2019, they said, can't do that anymore. You're
Right.
not, you're not going back and doing it. So the people got stuck with the stabilized. Well, the people that got the stabilized deal now, especially with rents frozen or
Soon to be.
becoming the case,
Yep.
and tremendous rise in income, and possibly now they're talking about rising property taxes, which are high anyway, and insurance costs and everything else
Forget
with
about it.
rents and the need of the building that are not in great shape to fix them up. Where are they going to get the money from?
They're not. And that's, thank you, Bill de Blasio. Thank you, Comrade Mamdani. But
Yes.
yeah, no, the fact of the matter, I'd once done an episode here with a woman, Ann Korshak, who runs the Small Property Owners of New York. And they're dying. Everyone looks at the landlord as being some fat cat with deep pockets, and that's
Not the
really
case.
not the case. But I digress getting into politics, so I apologize for that. I don't know how
That's okay.
I always seem to do that. Whether I'm at lunch with someone or on this thing, I always get into politics. But
Well, I do, except if I know someone's really way, way to the left, I like to choose a different subject.
absolutely, and it's usually pretty easy to tell.
Right,
So, so the plain vanilla deal is, and we're going to get into the borrower in a second, but the plain vanilla deal is just a solid, good deal that any banker or underwriter could feel good about. Now,
right.
when I had my company, we focused more on small balance deals that were not A borrowers, that were not A deals, and I call it, there were deals that had a lot of hair on them. So, how would you describe if you had to describe a deal with hair on it, what would something like that look like?
There could be a lot. There could be a property that has um, a couple, it may be an industrial piece, and maybe there's 4 units, and two of the units are gonna, in the next 4 or 5 months, the lease is gonna expire. and the bank's going to be overly concerned that the rent roll is going to expire or come down to a point that it may not be financeable. But now, if you deal with creative banks, and if I was bringing them and shopping, I would say to the banker, look, what's this we're going to do? Those two are going out, but it's a great location. So what we're going to do is we're going to give you 6 months or a year of reserves. And based on that reserve, it stays there with you until we replace those leases and that we're all good. So there's ways to mitigate risk and get involved with the bank, find a way to get that deal done.
So that's interesting because you touched a little bit on my next point where, a commercial mortgage broker is not necessarily a luxury, more like a necessity. And one of the big things, and for people who aren't familiar with commercial property, commercial loans, a big piece of the puzzle is storytelling. You have to, and I always say two people can bring the same deal to the same underwriter. One gets a yes and one gets a no. How do you develop? And storytelling doesn't mean telling fibs. Storytelling means painting a good picture of what may be a little bit of a tough scenario. So, how do you develop your stories that you feel that an underwriter is going to say, hey, you know what? Maybe that is worth a shot.
Because I think one of the benefits I have, because I've been doing this since 2008, I have a lot of experience and seasoned in the space. So when I hear a potential problem or I look at the deal and talk to the client, first I want to find out what are they looking for. Maybe they need 30-year amortization because they're worried about cash flow. Maybe they have a problem because they don't have the ability to do a personal guarantee. Maybe they have a problem because they have enough liquidity. There's all kinds of things that people have and are concerned about. And then once I understand where their priorities are, I kind of know which banks would be most fit for that client. So it's based on being like you in the title business, you become seasoned. And it's something that would have said, I would think, oh, it's a problem in title. And Mike would go, you would say, oh, no, I've seen this a million times.
It could
Let
be
me tell you
anything.
what we're going to do.
Right. So, one of the key phrases in networking, as you well know, is know, like, trust.
Correct.
And I would imagine that in the commercial mortgage game, if the underwriter trusts you, if you've been with them before, if you've told them a story that actually was true, if you describe a scenario and when they look at the paperwork, it actually bears out. How important is that trust factor when you're talking to a lender?
It's very important. But today, right, and I want to describe a little bit what I'm finding today that I haven't seen in a long time and what's changed dramatically, which I want to explain. Um, some banks, like I was at a networking meeting with a bank that I did an enormous amount of business with, and he said to me basically at the networking meeting, I'm tired of saying no to everybody because a lot of the banks don't want to lend on commercial. They don't, and for a variety of reasons. So that can interfere with the deal also.
Well, it's interesting you say that. Back in the day, especially getting close to 2008, well, 2007, there were banks who definitely did not want to lend. And as a borrower, and that comes into the whole question of do you use a banker or a broker? You take your loan to a bank. Maybe you have a relationship with them, maybe you don't, but they're not going to give you an immediate answer, although they really don't have any intention of funding your loan. And that kind of a time frame lapse, that kind of a waste is critical for a lot of people who are trying to get a refinance done or a loan done. So, I think the fact that these people and they'll be honest with you, I think saves the borrower a lot of time, trouble, and that's not even assuming that when it comes to negotiating the terms, you get them a much better deal. So, it's interesting how even an A borrower with a plain vanilla deal can go to his corner bank, but they might not be interested in that loan.
But even if they are, and that's what I like to talk about and give me a couple minutes to explain
Sure.
what's so different today than what it was in 2008 when you were talking about, and really when I started in the commercial space. So in 2008, when the markets crashed, basically, the Fed had to save the economy. So what did they do? The Feds put the rates down to basically zero, which was great for the banks because now banks could lend money at very low rates and still make an enormous amount of money. And that continued for 15 years, all the way through COVID and all the way through 22. So for 15 years, if Michael went into a bank and had 50 or $100,000 he wanted to leave at the bank would give him 0 to 25 basis points as the certificate of deposit, like very, very, very low interest. And when I was going to the banks to get ground up construction and perm loans, I would get loans for 3.5%. I even got like a 20-year deal for 2.9% because the cost of funds were so low. So when you weren't paying clients any money, and say the bank had an average of 25 basis points and was able to sell or have a commercial loan at 3.5%, they were still getting 15 times cost of funds. That was a wonderful thing for the banks.
Right.
So that went on for a long time, and it was great for the banks. So what happened? 2022 came around, and all of a sudden we had inflation again. So now the bank said, whoa, no, now we're going to the Fed raised the rates up to 5 or 5.25. And by the way, the people that were bringing the money to the bank said, if you're not going to give us deposits of any sizable amount, I'm not staying, my money's not staying at the bank. So you have banks today, like go to Chase, are giving 4%. Well, 4% is a great rate for us bringing in money, but for the bank, it's basically deposit cost of funds. Yes, they have some offset. They have checking accounts that they give 0 on, operating accounts that they give 0 on. So maybe instead of 4, it's 3, but whatever it is, it's a lot of money. So the banks have done things to I would say most of the banks that I go to, if they're interested at all, the floor rate's around 6.5% today, which is pretty high. And the truth of the matter is 6.5% isn't, and I'm going to explain to you, it's not even the real figure. Because if they were lending at 3.5% on 0 to 25 basis points on 4%, what would 6.5% mean? So they had to do other things. And what they did was they would have the gross income, which is when you do net operating income, you take the gross income minus expenses, basically. So they would throw in punitive vacancy fees. Even if there was no vacancy in the multifamily, even if the industrial had no vacancies, they throw in like 8 or 10%. And what would that do for the bank? It would reduce the amount of the loan. And then if that wasn't enough, at the bottom, it's called debt service coverage ratio, which I don't want to get too much in the weeds, but the way it works is you take the net operating income, you divide it by the debt service, and then you'll get your annualized amount that they can give you for the mortgage. So they raise those from 125 to 130 to 135 to 140. And again, it lowers the loan amount. And that wasn't enough. They demanded 10% deposits. So if you had a $10 million loan, for example, they want $1 million from you as a loan, not as collateral, and they probably pay 1 or 2% on it, which is way low. So that 6.5% is really 7.5 or 8%.
Right.
It's a killer. So
Right.
I'll give you like one quick example. So I have one that I just did a couple weeks ago, and my client said, I said to the client, "What's your loan?" He said, I have a great loan. I'm paying 5.9%. I said, "That's great. You have any deposits there?" "Oh yeah, got $500,000. I said, "So what do you get on that deposit?" "Oh, nothing." "You get nothing on the deposit?" Meaning the 500,000 to 4% is $20,000 a year. So I went back to the computer. His 5.9% had an effective rate of 7.4. He didn't know that.
So that's
Most clients wouldn't know that.
right.
And that's what's going on today. So I moved over the last year into the institutional financing and life co, because those companies do not pay clients dividends or money. They don't pay 4% or 3%. They don't have to pay anything. So the loan goes down. And those companies think about 20 to 40-year duration, not 5 years where all these things are changing. So in that world, we're seeing rates as low as in the 5% range, 30-year amortization, mostly personal, no PG, as long as the person's in decent shape. And there's probably not a bank in the world that compete with any of these institutional products.
So the fact that, I mean, you obviously know the business, and the fact, you take an A borrower with a plain vanilla loan who goes to his corner bank and isn't told a lot of these things.
None
And
of these things.
right, so you as a broker, you get paid. So people say, why would I go to a broker and pay him 1% or whatever it is when I can just go to my corner bank and get a loan and pay nothing? And the fact of the matter is that you don't know what you're getting. Nobody's telling you what you're getting. And after your fee and your negotiations, and we'll get into what you negotiate in a second, but you're saving them money and you're also giving them a better opportunity to have a successful loan and a successful project.
And it's not it's so not even close anymore that it's stunning what the results are today.
So
You
let's
can't, and
talk.
remember something else, the big thing also, when you go to the bank that trust and you say to the banker, I need what do you think I can get on the loan? And they'll say $3 million. They go through 3 months of environmental appraisal, everything, and they come back and they finally get a paper, and it was supposed to be around 6%, and the loan now states on the paper after 3 months, 6.5% floor rate. Um, and and the loan is, instead of 3 million, is 2.6, and the buyer says, and the person says 2.6. I thought we said three. Well, how did that happen? Well, you have to understand, we had to go through underwriting. Underwriting meant they were going to take the punitive vacancies off. Underwriting meant they're going to raise the debt service coverage ratios. All this meant that after 3 months, where are you going to go, man?
And
I
now
already have you.
and now that borrower may have to go into his pocket because instead of 3 million, he's getting 2.6. And I would assume that well, if it's
Especially on refinance, 100%.
100%. So an, as Cy Sims used to say, a knowledgeable consumer, I mean, every consumer should be knowledgeable. I mean, I talk about title insurance all the time, and nobody knows anything about it. And
Of course.
in your realm, where people are putting, in many cases, putting their name on the dotted line as a guarantor, they still don't know all of the aspects, which is why, in my article of should you go with a banker or a broker, you know what, it probably most of the time ends up being cheaper to go with a broker. So,
No, I would say not most of the time today. I would say 100%,
all right,
because I've done recent deals I've not that haven't closed yet, that I've gotten people 80% financing, which no bank is more than
right,
65 or 70%. Rates in the fives when most banks are 6.5%, and 30-year amortization. A lot of banks are 20 or 25. I even have deals with on office properties where most banks won't even touch it, let alone give it. And if they did, the punitive vacancy, I talked to one of the banks, was 15% on the vacancy for a doctor with 1,000 square feet, but the only tenant in the building. And I said, what do you charge him on the Oh, I charge him 15% on I said, 15% of the vacancy. There's no vacancy.
right.
I understand, but you don't understand. It's office, so we don't want to give that much of a loan.
So how do obviously you're providing a value. You and I mean, you're not the only mortgage broker, a commercial mortgage broker in the world, and you're all obviously providing value. What is it that prevents people from understanding the value that you bring?
I think the first thing is people get so consumed in their business. Like, I would think that most people don't think about title, meaning they may know that they need it, but they don't put their head through it. And people are so involved in their business or whatever they're doing that they also have a trust feeling for the guy that they use for 10 or 15 years, that how much difference could it possibly be? But
Right.
I know that the people that I talk to, when I talk to about rates in the fives, or the punitive vacancy fees, or things that I bring up, they're like stunned by this. They don't even believe this is so, but I have to tell you, it is so.
Oh,
And
I know it's so. So, I spend time trying to hammer my product, let people know that they can choose their title provider, and that's a very difficult thing to do. And title insurance is not like taking out a loan. So, how do what's your methodology for letting people know, for transmitting to the marketplace that, hey, you can do better, or at least the same, but most likely much better using a mortgage broker. How do
I
you?
think that it's hard. That is a challenge. So the challenge is there. So I've gotten more deals by talking to other brokers and saying, look, come with me. I'll get you a referral fee, get me the deal, and they're going to be blown away about what we could do together. So I have
Right,
a few brokers that I'm working with like that. Because if I don't have the person that the person that they have, it's going to be a great deal that they can share in, but they're also going to bring a great deal to to whoever we're providing this for. So that's really important. All right, I'll obviously work online and obviously reach out to people, lunch and learn, all kinds of different things to try to get as much traction as I can.
so
But I have
just
to
to
tell you, I'd say,
clarify, when you talk about a broker, you're working with brokers, you're talking about commercial real estate brokers, not other.
yes,
Yes. Okay.
commercial real estate brokers.
Right.
And I have to tell you, surprisingly enough, most people that I talk to don't even know don't even know what I'm saying, to this extent that they have their banks that they're working with.
That's right. And you know what? Like everything else, if you're a captive audience at your bank, they don't have to really take that much care in making sure that they're taking good care of you. They have you right where they want you. Almost like
Because
going to your mechanic.
Because I have I have another one that I just finished recently, and I won't name the bank because it's not important online, but the bank that I went to, he had a mortgage for about $5 million, and the bank wanted a $600,000 um, deposit, which he gave it to him. And it turns out that he's getting paid on it 3%, which is really low, and he's paying 6.5% as a floor. So again, he's probably paying over 7%. He doesn't even realize it. So
Right.
on the last deal, he said to me, Stuart, I can't do this. I want to buy this industrial for $7,750,000. I don't have enough liquidity. I'm concerned about it. First, I got him a line of credit to build up his liquidity to 4 million, but then I took him to an industrial and I got him a 75% LTV, which no banks would do. Um, so I think it's 5.8 million on a 7,750. No deposit, which it would have been a $580,000 deposit. I mean, think of what we're talking about. It's not 75%. So right away, you saved them at least 5% on the loan size on 7.7. You saved them $400,000 on the deposit there, and you saved them 580,000 on the 10% deposit that they want. So you've already saved them 1 million.
Right.
So that's besides everything. And the rate was 6%, not 6.5%. So how many different things? So this guy's going to save probably $1.5 million in a 5-year stretch that normally would go just to his bank and think that because of the trust relationship, that's the way it goes.
It sounds like he should be writing you a testimonial.
He should, yeah, and I should be able to raise my debt, my points.
Yeah, definitely. But no, it's interesting. So the institutional lenders who give you a better rate, who don't ask for compensating balances, uh, are they taking on additional risk, or is the traditional lender just making extra money?
Think of it this way. If you're a life company or institution that doesn't pay doesn't pay a CD to the client. You come in and I'm paying all my people 4%. And that's my cost of funds.
Right.
And now I have basically zero cost of funds. If I charge a person in the fives instead of 6.5 or 6.75,
That's true.
I'm killing it. You're not, the bank is hardly making money on the
Right.
deal.
No,
They're
that's
struggling at 6.5. That's why they have to put in the vacancy fees. That's why they have to ask for the deposits and pay that at a lower interest. So what they're actually saying to the client, which is not 100% true, so I'm not talking they're bad, but they're saying to the client, you have to pay 6.5, but they're really paying 7.5 or 8. They don't know that, and nobody's going to explain that to them.
exactly. Well, that's why. So, unfortunately, we're running out of time, but that's why people need to do their research when they're either spending their own money or whatever it is they're doing. You can't just take the first word as gospel. And I
And also,
think,
it's not their expertise. For most people,
of
I'm not
course,
talking about a big guy. It's not their expertise. So they're in the world of whatever they're doing. They just want to get their deal
100%.
done.
They have expertise over here, but not over here.
Or
And that's why.
past experiences that might have been good. Today is not the same.
So let's say somebody wanted to reach you. How would they do that?
Well, they could email me at Stuart at the
Okay.
liquiditysource.com, or they could call my cell, or they could ask you, and you
Okay.
could call
Well,
me.
what is
One
your
of the
cell?
516-353-6244.
That's
It's no
fantastic.
success fee. I mean, there's only a success fee if we get you a deal, and if you want a free consultation, I'll be glad to share anything that you need to explain it to you. If you want a loan sizing so you can know what a bank's going to possibly give you on the loan, I would be it would be fine with me just to give me a call. No
Well, let
cost.
me let me just add a testimony. I see what the passion that Stuart Gelb brings to his work, the way he tries to get to know his clients or potential clients, their scenario. He's not just mailing it in. And it's important when you're going with a broker that they do have those know, like, and trust relationships. And I know that Stuart does.
100%.
And if you went to him, he would take very good care of you.
That's
So
true.
if you would like to reach Stuart, you can look below in the description, and his contact information will be there. And I would like to speak with Stuart sometime in the future when the mess in the markets has cleared up and it's smooth sailing ahead.
I
Stuart,
appreciate it. Thank you so much for letting me join you. And do
oh,
you ever wonder?
thank you for coming.
Thanks, Michael.
Thanks for tuning in. See you next time. That's a wrap for this episode of Do You Ever Wonder? Thanks for listening. If you enjoyed the show, hit that subscribe button, share it with a friend, and drop us a review. We'll be back soon with more insights, experts, and conversations that make you think. See you next time. Do you ever wonder where curiosity meets conversation?